Hello and welcome everyone. My name is Jill Siegelbaum. I head the FX All Trading platform, and I am the moderator for today's webinar titled, Is Your FX MTF Brexit Ready? As you're all aware, the UK is exiting its transition period from the EU in about 3 months' time. This impending event has understandably raised many concerns with our clients about what the impact will mean for them, specifically their trading operations on FX platforms from the 1st of January. We thought it was important to address these incoming questions via today's webinar and highlight the position Refinitiv has taken to ensure a smooth transition for all of our FX clients. Before I introduce the speakers, there are a few housekeeping points I'd like to cover. At the bottom of the webinar screen, you should see a toolbar. Use the toolbar to access a range of applications, such as speaker biographies, amongst other things. Please submit your questions throughout the webinar via the Q&A box, and we'll try to get to as many as we can. If we run out of time, we'll respond to them through email afterward. We value your feedback, so please do complete the pop-up survey at the end of the webinar. We'll also be running live poll questions for you, so please look out for those on your screen and answer them as we go. Without further ado, let me introduce the speakers. We have my colleague Graham McGregor, who's currently overseeing the FX Relationship Management and Transaction Sales EMEA team, along with being the Chief Executive of Refinitiv's new legal entity in Ireland, which is our MTF. And we have Chris Leonard-Appleton, who is a financial regulatory expert and board member with experience working for trading platforms and in consultancy. For the last few years, he's been heavily involved in managing regulatory changes brought about by DoddFrank, EMIR, and MiFID II, initially in policy and advocacy roles, and latterly at Refinitiv to help clients implement these changes in practice. We're going to start with our first poll question to make sure you're paying attention. So the first question is, how confident are you that you can maintain seamless trading operations from the beginning of next year after Brexit? And while you're answering that, we'll give you a few seconds and then we'll just start our panel questions. So Chris, let's start with you. What is going on with Brexit, and what does it mean for FX trading venues and MTFs?
Hi, Jill. Thank you, and welcome everyone to this webinar. It's highly entertaining just looking at your the profiles of us earlier. I actually used to look quite youthful, and then DoddFrank, EMIR, Brexit, and everything else hit. So there's certainly a few more grey hairs. I think where we are with Brexit. So I think most people in the audience will be aware that, from the end of January, the UK actually exited the EU, and we entered into a transition period. During the transitional period, the UK has remained a member in many aspects of the EU, albeit without most of the rights of EU membership, notably representation. However, we have remained subject to the acquis. And what that has meant is that UK firms have been able to continue operating in the EU by virtue of their existing passports, really up until the end of the year when the transition period ends. Since the end of January, really the EU and the UK have been working hard on negotiating what the future relationship between the two parties will look like from the 1st of January. As part of the withdrawal bill that was agreed last year, a lot of that will be based on a free trade agreement. The relationship won't go much deeper than that. And for the provision of financial services, it was agreed last year that would actually be based on equivalence rulings. And the two parties have really been working on figuring out whether equivalence can be agreed by the end of the year or not.
Chris, are there any drawbacks with equivalence?
Yeah, I think there are a number of drawbacks. If we just pull up slide 11 quickly, the drawbacks are well documented. I think the industry's been talking about this for a long time. Certainly, if you compare equivalence to passporting or something like that, the scope of equivalence is much narrower. The regime is far more tenuous, and any arrangements can be rescinded with 30 days' notice unilaterally by the European Commission. So for a firm established in the UK who had been operating under the passporting regime to move to equivalence, that really is quite a substantial change in the legal framework on which you base your European business. So, yeah, I think there are a number of drawbacks to it. It is a relatively weak regime. However, that's where we are. That's what we have. However, since July, there's been a lot of doubt over really whether these agreements will be struck anyway. So on July the 7th, the European Commission put out a communique stating that most equivalence arrangements were highly unlikely to be agreed by the end of the year. At the time, we had a suspicion that CCP recognition and maybe share trading obligation equivalence would be agreed potentially, and certainly for CCPs that has come to pass. So CCPs will get time-limited equivalence from the beginning of next year for an 18-month period. But when you look at derivative trading venues, when you look at the rights of investment firms in general, it's highly unlikely, or it's certainly doubtful right now whether equivalence will be agreed. And that really has the effect of setting up a new cliff edge for a lot of business, from the beginning of next year.
So given the uncertainty of equivalence, what are the alternative options?
Well, I think the alternative options, if you're a UK venue, there are three. And if we just throw up slide 12 and be able to give a bit of a summary of that. The first option is equivalence. And as we just said, highly unlikely whether that will, highly doubtful whether that will come to pass by the end of the year. And obviously it does have a number of drawbacks. Absence equivalence, there are two other options, really. The first is to make recourse to something called reverse solicitation. Reverse solicitation, in effect, is where a European client can choose to approach a third country firm and request a service. In so doing, they give up a lot of EU rights, or they give up rights under EU law, so they need to be certain that the firm that they're approaching is subject to a robust regulatory framework in their jurisdiction. But there's a number of issues with reverse solicitation, notably differing interpretations throughout the EEA on how it should be applied. It's a directive article in MiFID. It's not part of the regulation, so member states have discretion to apply the requirements in different ways. There often is a very high burden of proof for the firm to demonstrate that they didn't actually solicit the client's solicitation, if I can put it that way. And if you can't prove that, and certainly some big jurisdictions like France, you could be deemed to be undertaking a licensable activity, in which case you've got a bit of a problem. And the other issue with it, it's really designed for incidental business. It's not really designed for recurrent business. If you're doing recurring business, and really you should be looking to move to a license situation, which then moves you on to the third set of options for a UK venue going into the EU. Would really be a member state by member state authorization. That is very burdensome. It takes an awful long time to get in place. In some countries, such as France, actually, my favourite example, you do actually need to establish local legal entities. You need to get you need to adhere to substance requirements within those jurisdictions. So put quite simply, it's not a very sensible route to go down if you're trying to maintain a pan-European business, because you have to go through 27 different licenses and it becomes very burdensome. And then, of course, the last option is to cease doing business with EU clients. Now, that is, I would consider to be a nuclear option. Obviously, that is entirely at the discretion of the UK venue. I can't comment either way whether a UK venue would choose to do that. But there is potential for that, and something that firms need to be cognizant of.
Thanks, Chris. So Graham, you've had experience dealing with some of these alternative options. What's been the client feedback?
Yeah, so first of all, I'd just like to wish everyone good afternoon, morning, and evening, depending where you're sitting. Joe, you're right. During our application to set up our MTF in Dublin, we're faced with a number of cliff edges around Brexit. And not being certain of the date when our license would be granted by the CBI, we did explore, several of these alternatives that Chris has discussed. So the member by member state authorization was sort of dismissed because we've got clients all over the EEA, and it would have taken far too long. We did look at reverse solicitation, and reverse solicitation is interpreted by each member state, and what we found, particularly from some of the member states, the interpretation was very limited, and that caused a big problem for many of our clients who were working with the local authorities when we were looking to sort of breach the period between we were granted a license and potentially when a hard Brexit happened. Now, thankfully, the hard Brexit didn't happen, and we didn't have to use reverse solicitation as an interim argument. But the feedback was very clear from both the local regulators and from our clients that if we had to rely on reverse solicitation, they would move off the platform. So that was our experience, and obviously looking at getting the full passporting rights from establishing an EEA MTF was always our primary driver, and that's what happened in October. And I'm pleased to say we've been managing the MTF over in Dublin very successfully since then.
Thanks, Graham. So we're going to go to our poll question number 2. And just to let you know, we're going to share all the responses to the polls at the end. So the poll question number 2 is, are you using a UK MTF trading venue for any part of your FX executions? Any part. And we'll share the results at the end, all of them. So next question for you, Chris. Do you think equivalence is guaranteed to come into effect at all?
No, I don't think it's guaranteed at all. And I think if you look at what the EU is doing from a macro perspective and the pressures that it's facing, so first of all, I think there's a real drive to self-sufficiency within the EU at the moment, and we're seeing examples of that all over the place, not least of which around outsourcing, delegation by asset managers, and also equivalence. So if we take CCP recognition, which obviously occurred a few weeks ago, I think it's safe to say that the EU acted there in self-interest, which is entirely pragmatic on their part. They saw clear systemic risk issues if they didn't grant UK CCP's equivalence. But what they have done is provided a very clear glide path of 18 months to UK CCPs to actually start relocating operations back into the EU. So I think UK CCPs have been given clear instruction by the European authorities to relocate those activities. And actually, if you fast forward to the middle of 2022, and you look at the political environment, then it's going to be in the middle of the French presidential elections, and it's going to be in the middle of the rotating presidency by France of the European Union. So I think, put bluntly, I do not think Monsieur Hollande is going to be in any mood to look to be acquiescing to any demands by the UK at that point. So I think the 18-month period probably won't be extended. Now, if you look at the other equivalence areas, I mean, share trading, I think the European Union has learned from the Swiss experience that actually not coming to some sort of arrangement in this area can cause all sorts of issues. So I'd suspect that we may see something move with the share trading obligation. And actually, if you look at the negotiations around the MiFID quick fix at the moment, certainly Ireland seems to be pushing an accommodation quite strongly there. But if you look at the other equivalence arrangements, they just aren't the same systemic drivers. I mean, there's an awful lot of operational overhead. It does create an awful lot of inefficiencies not having equivalence, but I'm not sure those arguments actually trump the EU's desire for self-sufficiency. And this whole self-sufficiency argument is coming from, the EU is having clear issues with the United States and its trading relationships there. It's having issues, political and trading, with China at the moment. Those are your two big blocks. And I think the EU is taking the view that it needs to be able to stand on its own 2 feet. And actually having its financial services located offshore in the City of London I don't think is overly palatable to EU regulators. So, there is a clear drive to onshoring, and just providing equivalence doesn't necessarily help that. So I'm not discounting the possibility that equivalence occurs at the end of the year. There's always scope for, with CCP recognition, to grant temporary equivalence and potentially do something later in 2021. But at the moment, the augurs seem to be pointing to a smaller probability of any agreement occurring.
Aside from the potential for UK venues to stop doing business with EU clients, are there any other operational impacts to clients using UK venues?
Yeah, I think there's a few operational impacts, and really they can be categorized, I think, into two areas. So reporting and best execution. So if we take reporting first, this is actually, particularly in the area of post-trade transparency, which is more applicable in FX. I'm not going to focus on pre-trade because we don't have that yet. This is where we're seeing examples of asymmetries actually emerging between the UK and the EU. So from a UK perspective, if a UK firm trades on an EU MTF, the FCA to date has been of the view that post-trade transparency obligations in the UK would be met, and therefore the UK firm would not need to post-trade report to an APA. What we're not seeing is ESMA reciprocating. So what we know today, and this may well change, but I'm not too sure, is that if an EU firm is transacting on a UK venue without equivalence, the EU firm may have to undertake post-trade transparency in the EU to an EU APA. So that's operational issue number one. It's a thematic one that's coming up at the moment, which we're hearing from clients. And then for best execution, where this is proving problematic is this: if you actually look at a lot of asset management firms' best execution policies, they explicitly state they will execute either via routing or directly on an EU regulated venue in order to meet the best execution requirements in MiFID. And the issue with that is, UK venues cease to become such that there's no equivalence from 1st of January. So it's unclear then, by executing on a UK MTF, how the asset manager can meet its fiduciary duties to European funds or to European clients. And then just moving away from the buy side slightly and just looking at the banking community, we've got the perennial issue of SI thresholds, so the systematic internaliser regime. Today, under EU law, OTC volumes have to be counted towards those thresholds. Any volumes transacted on an MTF or regulated market are not counted towards those thresholds. Of course, from 1st of Jan, without equivalence, any volumes transacted on a UK venue would have to be counted towards those thresholds. So it's just another one of those operational niggles that's starting to really come up right now. And of course, I haven't really talked about the IRS and the CDS markets because we are focusing on FX. But without equivalence, I think it's been well documented what the operational impacts will be there. UK funds will have to trade on UK venues, EU funds will have to trade on EU venues. For particular instruments, it depends where the ROPA scope of the trading obligations comes out. But that could quite naturally have issues not just for liquidity, but also operational workflows as well.
Thanks, Chris. Graham, what preparations have Refinitiv taken to support clients on our FX platforms?
Yeah, so Jill, as I touched upon just before, we decided when operating in the EEA, it's really important to have passporting at the heart of everything you do. It means we don't need to worry about these questions around equivalence or any of the other sort of tenuous arguments. So obviously we established our MTF in Dublin, and clients they are using the MTF today from the EEA perspective, of course, will be able to continue to use that in post-Brexit. And additionally, to make sure that we protected our UK clients using our MTF, we made an application to the FCA for their temporary provision regime, which essentially extends the same passporting rights that they enjoyed pre-Brexit to post-Brexit. And as Chris said, the UK is a far more permissive regime. And, the asymmetrical nature, I suppose, that the UK are taking in supporting the financial industry means that operational issues around post-trade transparency and potentially upholding best execution requirements are not an issue for our UK clients in a post-Brexit environment because of the temporary provision regime that we have in place. So having our MTF and having our temporary provision regime insulates all of our clients today to be able to continue to do business as they did before and not to worry about any other operational issues that they may have elsewhere.
Thanks, Graham. Chris, back to you. We've had some questions from clients asking why we're so confident that UK clients will be able to continue using the MTF from January. Can you provide your view on this, please?
Yeah, sure. And I think this is somewhat of a multifaceted issue because of the way that you have interplaying different laws actually playing out here. So I think we boil this down into two lenses. The first lens is the ability of the MTF to operate in the UK, because under passporting rules today, that's kind of what's assumed when we allow UK clients onto the venue. But the second lens is actually the client lens, and this is where things get convoluted quite quickly. The client can be deemed to be undertaking an investment activity in Ireland when they use the venue in Ireland. So we've had to look at both lenses here. From the MTF operating in the UK, as Graham says, we have made recourse to the temporary permission regime in the UK. We're not using the overseas persons exclusion in the UK for a number of reasons, not least of which we still have a significant marketing and sales operation in the UK. So just, the OPE isn't sustainable. What that TPR allows us to do is to continue operating by and large the way we do today under passporting. And then the FCA will provide, we understand, a 1 to 3 year glide path to move to a full authorisation in the UK. And we effectively have to wait for the UK to instruct us to do that from the beginning of next year. So that's all fine. We will have a UK authorisation at some point from Ireland, and I think we'll be on pretty sound ground there. The other way round, if an EU client, if a UK client is using the MTF, they are undertaking an investment activity, either execution of client orders, dealing on own account, whatever it might be, which obviously Irish law would require a licence for. So last year, we actually undertook a pretty significant due diligence exercise to ensure that all of our clients either were exempt firms under Irish and EU law, which is the case for our corporates and for a number of AFMs or UCIT funds, or that UK financial firms could continue to use what is known as the Irish overseas persons exclusion in order to use the MTF. And with the exception of a couple of clients where we've had to do a lot of work with them to really restructure their operations, they've been highly cooperative in working with us to do that. The due diligence exercise was a success. I thank all of our clients who actually helped us with that. And we're really confident that all of our UK clients would meet the respective bits of Irish law and therefore be able to continue using the MTF. So very long and convoluted answer summarised. We're perfectly confident for a number of reasons, more of which I can go into in bilaterals if people want, but there's always the risk that they go to sleep.
So great. So given Brexit, MiFID, DoddFrank, how can global firms leverage Refinitiv's regulatory setup to support their global operations?
I think this is where we need to go back to first principles of, how we choose to do business and the sort of service that we want to provide to our clients. And if you look at the FX market, it is an inherently global market. In fact, its characteristics make it the most global market. But the issue is that we know that with things like DoddFrank, Brexit, MiFID, which have all been, blue chip restructuring exercises at its most basic level, that there is a lot of localization going on. There's a lot of onshoring going on. Jurisdictions are sort of trying to put their arms around businesses that are operating within their jurisdictions, which makes operating a global market very difficult. So we think global, but we act local. And the way that we've done that really since 2013 we established the CEF in the United States. That's been operating for NDFs and options since the introduction of DoddFrank. With the introduction of MiFID, we introduced the MTF in Ireland, in the UK. We've since migrated that over to Ireland as a result of Brexit, and we also operate an alternative liquidity venue out of Singapore. Each of those venues then has secondary licenses to operate in key jurisdictions such as the Canadian provinces, Australia, Switzerland, Singapore, Hong Kong, etc. So that structure really enables us to implement or follow the sum model in a technical way quite seamlessly.
Thanks, Graham. So given what Chris just pointed out, can you share, you're dealing with clients all the time, what's the technical setup in FXall that makes this easy and possible?
Yeah, thanks, Joe. So, I think from the onset, we recognized that local regulations are likely to continue. And, we know we have, DoddFrank, we have MiFID, we may well have a UK local regulation that we need to follow in some time, and potentially out of Singapore as has been muted. So looking that, our clients typically are often looking to be increasingly more global, but then being hamstrung, I guess, by local regulations. How can they operate a global business with this local requirements? And that was really at the heart of our thinking when we were putting together how we would manage this in the platform. So, we have clients who may have multiple legal entities in a particular country, or they may have multiple legal entities across different countries. And they may want to follow the Sun model, or they may want to house everything in one country and trade multiple time zones from there. So simplicity and flexibility was absolutely key for us. And I think our biggest sort of innovation was the multiple LEI structure, so the legal identified structure that we've got in place. It makes it very easy. We effectively have a parent entity with local entities underneath. And so if you're following a global Sun model, you can have your Asian, US, European, and potentially UK entity. The benefit for the client is the SDP is usually consistent. So once you're connected in one place, you're connected across all venues. So it's very quick to onboard other branches, other legal entities, and other jurisdictions. Mapping and liquidity tends to be consistent. So again, for clients wanting to onboard in different jurisdictions, it's usually very easy. The mappings to our provider banks are already in place. And again, clients can move onto the platform seamlessly. And for people, traveling, not that the people are doing very much of that at the moment, unfortunately, but for traders moving from the UK maybe over to Asia, or from Asia over to America, we set up with the legal entity structure. Depending on where you're trading, that would be the entity you would trade under. So the user ID moved to the legal entity to where the trade was being executed. And it also means our reporting is consistent. So, the firms didn't need to worry themselves when they're sending orders through where reporting would be done. If the trade was routed to the CEF, we would manage it through the appropriate channels. Again, if it was routed to the MTF, we'd use our APA for post-trade transparency reporting. So it's all very seamless. So we've stitched everything up in the background, single sign-on for all users, consistency across the GUI. So whenever an order is sent through, it will be routed according to the setup and jurisdiction it's been sent. The other thing I think that's been useful, some clients want to see an aggregated TCAs on their data. Others would like to see it broken down by entity level. So putting that structure in place, again, allows us the flexibility when clients want to view the overall book or just the legal entity group. So that's the main technical piece that we put in place to help stitch all these local components together to allow, a sort of seamless global follow the sun trading model.
Thanks, Graham. Chris, what other operational issues should our clients be thinking about in the run-up to Brexit?
Well, I think the operational issues which I'm about to lay out, I know all of our clients are thinking about them already, but I'm just saying it to be consistent and comprehensive. There's the bit which is outside of FXall's control, and that's your direct banking relationships. So, I know that some significant repapering exercises have been occurring over the last 2 years, really, in preparation for Brexit. If you haven't been having those conversations, then really they should be happening. But primarily what's going on there is where either UK banks or American banks located in the UK are relocating operations to Frankfurt or other jurisdictions. That obviously causes a change in relationships with the European accounts. So that needs to be done, and a remapping exercise also needs to occur within FXall, which is driven by the bank. So if there's any question marks over that, I'd encourage you to contact your relationship manager pretty quickly. But also talk to your bank pretty quickly as well. The only other thing which I will add, and this is purely for information purposes only, from the 1st of January, whether we get equivalence or not, our Irish MTF is going to have to treat all UK firms as non-MiFID firms for the purposes of MiFIR transaction reporting under Article 26. It's for information purposes only because you guys don't need to do anything about that. We have an admin job that we need to do on our side that we're planning. We will simply flip the MiFID categorizations in our admin systems over to MiFID No so that we start reporting for all UK firms from the 1st of January to the Central Bank of Ireland. That doesn't change any UK financial firms' obligations to report to the FCA. It just means that the transaction reports will be going to the FCA and to the CBI. I think that's largely it, Jill.
Okay, thanks, Chris. So we are going to our poll question number 3, and then we will share the responses to the poll. So the final poll question is actually the first poll question. After all that you've heard today, how confident are you that you can maintain seamless trading operations from the beginning of next year after Brexit? And after this is responded to, we'll share all of the responses, and then we'll get into our Q&A. So can you bring up the responses, please? So for the first, we see 34% are confident, 53% are somewhat confident, and 12% are not confident at all. That was the first one. Let's go to the second poll question. Are you using a UK MTF trading venue for any part of your FX executions? 50% yes, 30% no, 20% don't know. And the last poll question, which was the first, let's see how different it is. So it looks like it's changed a bit. So we see more movement to somewhat confident.
But more people are confident as well.
Yeah.
Well, that's good.
Some benefit then to some of the questions that have come up.
Okay, let's move into our questions. So the first question, I think, for you, Chris, for a UK asset manager, how are they affected if they're executing on behalf of both EU and UK domiciled funds at the same time?
Well, I think in FX, and it's a good question. The key issue really is around the fiduciary duty of the asset manager to each of the different funds. Obviously, we know in FX we haven't got issues with trading obligations or anything like that, so we're not worried about bifurcating trading on UK and EU MTFs to satisfy respective trading mandates. So the key question comes down to, if you are a UK asset manager and you've got to satisfy best ex requirements in the UK and also best ex requirements in Europe for your European funds, and you haven't got equivalence, how do you actually go about doing that? So I think that's probably the key question. I mean, I would just reiterate at this point that, with the EU MTF under the TPR and obviously passporting, we're pretty satisfied that we would be able to meet best ex obligations in both the UK and the EU if your policy stated you needed to trade on a regulated venue.
Thanks, Chris. Another question, are you applying for a cross-border license under the TPR?
Well, that's a very good question, and actually something that we're discussing with legal counsel and with the FCA. For the time being, it will be cross-border. We don't have a branch established in the UK or anything like that, but our expectation at the moment is that we would need to establish a local presence in the UK under an authorisation regime in the UK. But as I say, we're discussing that with our lawyers, and we will be able to give more details in due course on that.
Okay. Another question that came in. We use Refinitiv Electronic Trading Standard as a white label program for our clients. We hedge our deals via the trading applet with hedges towards the same LPs as we have on FXall. Do our hedge deals get covered under the MTF legally?
So from my knowledge of FXall, if it's obviously within the spot market that you're doing that, then it's unlikely to be coming under FXall. That's normally a direct LP relationship, but it depends entirely how you're set up in ET. If you're auto hedging in swaps or forwards, then that will ordinarily come via FXall, or indeed, it could be going via Bloomberg or 360T. ET does integrate with the other venues as well. So it would depend entirely on your membership. As you're auto hedging onto the venue, you have the direct membership, not your client. And it would therefore depend on whether you're set up for the MTF or not on FXall. So, we would have to look at how you're set up to be able to answer that accurately. But most of the time it would go via the MTF.
Thank you. Here's a question for you, Graham. What is a multi-dealer platform? How do you define that, and why does it need to be an MTF?
Yeah, I better be careful how I answer this. I'm quite passionate about this. If anyone ever speaks to me, there's been, I guess, a differing view in the market. A large number of multi-dealers have gone through the rigorous process of setting up CEFs, MTFs, and other venues and being regulated. And I think traditionally those venues have always been participating in the FX market. There are some venues that, maybe their origins came from more from the equity market, and the argument, I guess, from them is that they're just simply pass-throughs, so they're technology pass-throughs. I think I can understand that in the equity world, passing orders onto a broker, which then go onto the exchange. On the exchange, the price formation occurs and the deal is executed. But I think the difference in the FX market is an OTC market, and so there isn't an exchange. And when you have an individual access a GUI, send an order out to multiple providers, albeit it's a bilateral message, and then has an aggregated message coming back into the GUI. So that's the formation of the price, which is then executed on that GUI, albeit it's confirmed on the bank server. I think that is a pretty clear definition of what a multi-dealer is. And I know the Dutch regulators recently came out and are really keen to push for this consistency around what is a multi-dealer and what needs to be an MTF. And I'm pretty confident from our interpretation and certainly talking to some of the other clients and even some of the other competitors that it will probably be borne out that our interpretation of what a multi-dealer is, and therefore what needs to be set up as an MTF, will likely be accepted by the European Commission. But of course, we need to wait for these things. And from a Refinitiv point of view, I'm pleased that we've implemented all this work. It takes a long time. It took a lot of budget, and it took a lot of focus away from developing other features. But the good thing is it's all there now. Our clients can trade seamlessly on any regulated venue that they wish, and we can manage their regulatory obligations. So that was probably a far too roundabout way of saying, I think that, we are a multi-dealer platform, and therefore we're an MTF, Joe.
Thanks, Graham. Chris, here's another one for you. How is your legal structure with only one MTF affected by the derivative trading obligation if no equivalence is agreed?
Well, there's no real impact simply because there's no trading obligation in FX. So that isn't a problem. It's, it's not like we have to have a UK MTF to meet a UK trading obligation from Jan 1st, because that simply doesn't exist. If we get to the point where we move to clearing mandates in FX and then to trading mandates in FX, then obviously we will need to reevaluate that. But for the time being, we're satisfied our legal structure will serve both UK and EU clients.
Okay, thanks, Chris. I think we'll move to just sort of closing, and I want to thank everyone for joining us today. Is there anything, Chris, Graham, you want to add just to close up?
No, I think the only point for me, obviously with a lot of the incoming questions that we had from clients, I hope that what we've talked about today from our Refinitiv perspective, people have confidence that they can continue to use the platform today as of Jan 1st as well. So there'll be no impacts from a Refinitiv point of view. And the purpose today was really to try and highlight that, from our perspective, we think we've got everything covered. And if anyone would like to follow up with Chris and myself to discuss one-to-one any specific issues at the firm, we're more than happy to get on a call with you. But I really appreciate everyone's time. And as you may see, for the first time in a couple of weeks, it's actually sunny here in Scotland. So excuse me if I've been squinting occasionally on the screen.
Thanks, Graham.
Chris, spontaneously combusted, Graham. Yeah, thanks, Joe. I think I was shivering to myself, and Graham said we've got it all covered, because we always know that with these things, something comes out of the woodwork and affects us. But I think generally speaking, we're in a good place. I think generally speaking, we're really well placed to help our clients towards the end of the year. And our door's always opened if you want to have a conversation, either going through some of the operational impacts, how we can help, anything along those lines. And we're always here at your disposal to discuss those.
Okay, thanks everyone for joining us today. I'll remind you to please take 1 minute and fill out the pop-up survey that will come as soon as this ends. And we really appreciate your time. Thanks very much. Have a good day. Bye-bye.
Thank you, everyone.